Welcome again, and for our today's session we are going to concentrate on how to prepare a bank reconciliation statement, that is the BRS. And many a times we ask ourselves, what is this special type of a statement? It is basically that statement that is normally used to bring the agreement between the bank balances in the cash book and the bank balances in the bank statement. Remember, many a times these two balances may not agree, and let us just ask ourselves, out of those, we have the cash book and the passbook, which represents the bank statement. Cash book is prepared by a business. Passbook is prepared by the bank. The bank balances in both are supposed to be equal. If they're not equal, it means there could be some errors. For example, there was an overstatement in either of the books, or there could be some checks which have been issued to the bank, but the bank have failed or have not yet credited. Or maybe you could have some banks which have already been presented to the bank but have not yet been credited in that case. So it means one book balance is going to be higher than the other. And we are going to see, actually, for example, in this our example, we are told that the cash book of Tom showed a balance of 9,100. The bank statement, however, showed a balance of 7,900. It means there is a difference between the two balances. So we are going to see actually how can we correct that to bring them to agreement. And maybe for your question, a cash book is prepared by a business. It means, if a business, for example, deposits some amount of money, let's say 50,000 to the bank, whatever has gone to the bank is an asset to this business. And the cash book is going to be debited using the double entry principle for assets. When assets increase, they get debited, in this case, with that one. But now whatever has been taken to the bank is a liability to the bank, because whatever is in the account of the business, the bank may be commanded or requested to pay at any given time. They're just holding it temporarily. So it means whatever is in the bank increases their liability. And when you increase liability, you're supposed to credit in that case. Then look at, for example, so when there's a decrease. When there's a decrease in the cash book, means maybe the business has made some payment to the supplier, for example. So we decrease what is the cash book. And when amount of money in the bank is being decreased to pay the supplier, it means the liability to this bank is reducing, because they will be liable for a small amount of money that is going to remain. And in this case, we debit a decrease in liability. Then we're supposed to know that the debit side of a cash book normally corresponds to the credit side of the bank statement, and the debit side of the bank statement corresponds to the credit side. Money moving out of the bank is increasing on the credit side of the bank statement. So money increasing from the cash book must have decreased from the bank statement. That is what it means. Now, because of the two errors, or the two differences in the balances, we are going to see how to reconcile the bank statement. And we normally start reconciling by updating the cash book. So, how do we update the cash book? We are simply going to identify those items or those amounts which were supposed to be in the cash book but were not entered. And of course, we are going to debit them. Whatever is supposed to be in the cash book and was not entered, we are going to debit them in the cash book. And on the credit side, we are going to enter whatever that tends to decrease the cash book, so that you can be able to get an updated cash book balance, which will be taken to the bank reconciliation statement. And also we are going to explain how to go about that one. Now, we have bank balance of the cash book is 9,100. So the cash book has a bank balance, and normally a cash book has a debit balance. So we are going to start with 9,100 as being balance brought forward. It increases the cash book. And then you look at the transactions which are supposed to be increasing the cash book and are not there. That is how we are going to update this. Like we are told, a check 500,000 received on 10th of December from Stella entered to cash book but did not appear in the bank statement. Now this one is already in the cash book. We won't deal with it in either side. Let us go to the second one. We only deal with those amounts which are supposed to feature here and are not yet featuring. Then we go to second, check paid to Sam on 20th December, that is an earlier date, which is an amount of 50,000 had not been presented. Now you see this check. If a check was paid to Sam, it means the cash book was credited. So it means there is already an entry in the cash book, and also we are not going to deal with that transaction. They will become part of the reconciliation part. We go to the next transaction, the next error that was discovered. Bank charges of 200 had not been entered in the cash book. Now this one is not featuring in the cash book. We only enter those values which are not featuring in the cash book. Like here we have bank charge. Normally a business charges a bank charges business some fees to do with the ledger fees, commissions, and all that. Now the bank has already charged the business, but this amount is not featured in the cash book. It means 200 shillings is supposed to be reducing what is in the cash book. So it's supposed to be credited. Now we have bank charges. Bank charges of 200 shillings is not featured, it's supposed to be there. Then we go to the next one. The bank received directly on behalf of Tom a check of 1,000. Now you see, this is a type of an error whereby the bank is receiving a check. So it means this amount of money went to the cash book. It increased the cash book. But it was not featuring in what? It was not featuring in the bank statement. So when a check is received, we are going to have something to do with a direct check. We have direct check, which is an amount, let's put it this way, direct check, which is an amount of 1,000. Then you go to the next error. A check payment of 1,500 to Alex had been entered in error of 150 in the cash book. Now, this business made some payment to Alex, which is supposed to reduce the cash book, so it's supposed to be credited. Instead, a wrong amount was entered. It means there was an understatement or undercasting. So how do we correct this one? We get the difference. If 150 was recorded instead of 1,500, it means the difference of 1,350 is still inside this cash book. So it's supposed to be reduced. So we reduce that one by what is called error in check. we will call it error in check. That is simply an error of transposition. So that is 1,350. We are reducing what is still inside the cash book, which is making the cash book not to reconcile with the bank statement. Then we go to a check of 600 received from Alicia and entered into the cash book, was returned dishonored. Now there's a check which has already been received. So it means that check, upon receiving, it increased the cash book. It was debited, but later it was dishonored. We have so many reasons why a check could be dishonored. Maybe the check had some wrong signatory, the check had expired, and so many reasons. So we are supposed to reduce what had already been received. And when we reduce the cash book, we are going to credit. So we have Alicia corresponding to dishonored. This was a dishonored check of an amount of 600. Then we're supposed to add. When we add the two, we now get the balance as per the cash book by getting the difference between the two. So when we add on this one, we are supposed to get 2150. 2150, 7,900 minus 2150. It's supposed to be, well, it's supposed to be 7,950. Supposed to be 7,950. So this is the balance as per updated cash book. Updated cash book. The balance as per updated cash book. Then of course we get the total here because that is what we were trying to calculate. Then we get the difference between the total of this one and this one. We get that one, 7,950. Now here we have what is called balance as per updated cash book. Now, from what I gave you here, when you have balance as per updated cash book, means an overdraft as per the passbook in the bank statement. And an overdraft means a credit balance. So it means this business, they owe the bank an amount of 7,950, okay, which they are supposed to pay to the bank. So when we start with the balance as per updated cash book, we are going to see the formula. That is the balance as per updated cash book, which is a credit balance of 7,950 for that particular reason. Then we are supposed to add unpresented check. Now, what is unpresented check? This is a check that the business had written to a supplier who failed to take to the bank. Now you see, in this case, the cash book has already been reduced with that amount of check. But still now, the balance in the bank is still higher. It's supposed to be reduced because that check is supposed to reduce the cash book and also reduce the liability. Now we're supposed to add it because it still forms part of the cash book. So we are supposed to add unpresented check. Unpresented check. Now, who had unpresented check here? Let us see. We have check paid to sum on 20th day for 50 had not been presented. So we have a check from sum. We are supposed to add that value for 50 shillings. And why is it a debit? Because it is still part of a decrease. It's going to be form part of a decrease in liability upon payment of that check. A decrease in liability to the bank. That is why we debit that check for 50. And we also are supposed to add any errors increasing the bank statement. And errors that increase the bank statement could be due to maybe overstatement. And for this case, we don't have overstatement, so that one should be that. Now, when you add this one, supposed to be this one plus this one is supposed to be for 50 shillings. When you add the two, when you add the two, is supposed to be this is 0, 0. That is 4 and 8, 8,000. That is 8,400. Then we less uncredited check. We less uncredited check. Uncredited check. And this type of a check means that the bank has already, this check has already been reflected in the cash book, but the bank has not entered it in its books. So we are supposed to bring this cash book and the bank statement in agreement by lessing what is in the cash book. We are lessing because it is in the cash book and not in the bank statement. So we try to negate that. We less so that the total in the cash book can come into agreement with the total in the bank statement, because it has not already been featured in the bank statement. And maybe if we have any check which was not, for example, the first error is check 500 received on 10 from Stella, entered to cash book, but not appearing in the bank statement. So we do away with it, so that you can assume that it is not featuring any by lessing. And it was a check from Stella, an amount of 500. And then what do? We also less errors decreasing bank statement. We less errors that decrease the bank statement. Why? Because whatever is trying to decrease the bank statement, we assume that they are featuring in the cash book. So we less them from the cash book so that the two can come into agreement. And because of this case, we don't have any error. And for that matter, we only deal with this x. If there's any, you will put the values. So we have 500. When you less the 2, 8,400 minus 500 is supposed to be 7,900. Now this 7,900 is the balance. This is the balance as per bank statement as at 31st December